Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, August 16th, 2024. Hope everyone's having a good summer. So we'll start with our executive summary, as always, from our leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what does the housing market signal about the health of the U.S. economy? Our answers are the latest homebuilder sentiment and homebuilding activity data were unsupportive of our call for U.S. growth to continue surprising to the upside over the medium term. Specifically, the NAHB Housing Market Index declined to an 8-month low in August and missed consensus expectations in the process. Building permits and housing starts both missed consensus expectations as well. On a seasonally adjusted basis, building permits and housing starts declined to the lowest respective levels since June of 2020 and May of 2020. The signal from the housing market is not what it used to be. Still, it is important to monitor trends and inflections in the housing cycle as a barometer for animal spirits within and the overall health of the U.S. economy, because housing market activity is a persistent leading indicator of the business cycle. And this persistent leading indicator is one of very few that suggests growth might be slowing faster than we in consensus currently expect. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This was a good one regarding China themes. It says, hi, Didi. Based on the recent fundamental research summary, which we publish daily in each of our 42 macro research reports, which highlights, so the fundamental research summary, which highlights a bullish outlook on China due to the China front-loading stimulus theme. While this theme suggests potential for long positions, I'm aware that Dr. Mo, which is our discretionary risk management overlay, Dr. Mo's trade recommendations recommends a short approach due to the current hybrid market regime. Given these strategies serve different purposes, one's to look around the corner and one's versus current positioning, I'm curious about how the best approach is in respect to adding exposure in this context. Once a position is established, would it be wise to use the BAMs for FXI to guide position sizing and perhaps set aside the conventional trade logic in this instance? The rest is just kind of qualification. So phenomenal question. I think this is one of the better questions we received over the past couple of weeks in terms of how to not just use our investment process to achieve superior investment performance, but how the best investors in the world achieve superior investment performance. As you guys all know, I spent my career traveling around the world, meeting with institutional investors, having debates like this, and trying to build repeatable quantitative processes that allow us to consistently stay on the right side of market risk. And with respect to the question here, essentially the gist of the question is, okay, you have a bullish fundamental outlook on China, but your risk management systems are telling you to be short China right now. And that's a very important distinction to make, because one of the things we do here at 42 Macro that we've observed many of the best and most respected buy-side PMs and CIOs do at their respective firms is they keep their fundamental research views separate from their risk management signaling. They use their fundamental research views, as the client just indicated, to peek around the corner to anticipate how their positions might evolve over time. But at the end of the day, what gets them in and out of positions, or what gets them to increase or decrease their exposure to an existing position, is really just primarily a function of whatever their risk management process is. And so investors should be aware of that. If you're not doing it that way, you're doing it a way that's different than what most of the best and buy-siders are doing. So generally speaking, if you're going to do something, you're going to want to try to emulate the results in the process of the people who are doing that thing best. And that thing, obviously, here is investing. And so with respect to going back to the client question specifically on China, our best advice is to respect the evolution of the volatility adjusted momentum signal in FXI, and respect the evolution of the market regime, because those are incredibly powerful tools to keep clients on the right side of market risk. Specifically, if you look at our back tests for our volatility adjusted momentum signal, 274% of the cumulative performance in FXI in the China stock market has come when our signal has been bullish from the perspective of our volatility adjusted momentum signal, which means that it has and minus 433% of the cumulative performance has come when it was bearish. So it tells you that if you were just going to be long China, naked long China, you would have a higher probability of actually outperforming what the overall index return is if you just were long China when it was bullish, and you would have a negative return if you were long China when it was bearish, according to our signal. So obviously you shouldn't be long China when it's bearish. Specifically, if you use our narco regime nowcasting process to stay on the right side of Chinese equity market risk, then you would have a 169% upside capture ratio if you just were long China and risk on market regimes, and you'd have a 69% downside capture ratio if you were long China in a risk off market regime. So obviously you don't want to do that. And that's exactly what our discretionary risk management overlay, aka Dr. Mo, does for clients, is it combines the signal from our top-down market regime nowcasting process with the bottom-up volatility adjusted momentum signal for each of the main liquid exposures across all of global macro to get to generate a proper trade recommendation for that particular exposure. And I want to say for the for FXI currently, the proper trade recommendation is short half position because China is currently neutral VAMPs and we're in this hybrid market regime that they highlighted. So again, you can have a fundamental research view, and our fundamental research view is fundamentally bullish, cyclically bullish on the on Chinese equities because we expect the PBOC and Beijing to step up fiscal and monetary support for the Chinese economy, primarily through the property market over the medium term. But what the market is essentially saying, we're not there yet. So the market is essentially saying the market doesn't believe our views yet. And as an investor, it's far better to be the second investor in a confirmed trade than a first investor in a trade that never materializes. And that's exactly what Dr. Mo does for our clients, is to make sure that they are the second investor in a confirmed trade, as opposed to constantly putting on trades that the market disagrees with that cause you to lose money. And at best, if you put on trades that the market disagrees with, then at best you're going to be paying an opportunity cost because you're not long the things that are actually going up in price. And at worst, you're going to actually lose money because it's the wrong time to put on that fundamental research view. So I'll wrap up by saying, just because you have a fundamental research view doesn't mean it needs to occupy units of P&L and units of positions in your portfolio. You can have a fundamental research view and have no position associated with that fundamental research view because your quantitative risk management signaling, which again should be separate if you're doing this properly, if your quantitative risk management signaling doesn't tell you to put that fundamental research view on, then you shouldn't have a position in your portfolio associated with that fundamental research view. You should only have a position in your portfolio on when both of those things are in alignment. And that's how you prevent yourself from making big mistakes, blowing up your portfolio. And obviously, if you don't blow up your portfolio, you're going to be compounding returns from higher levels of capital over time, which, as we all know how compounding works. I want to say Warren Buffett said it was the eighth wonder of the world for the reason. So this is all stuff that we do for our clients here at 42 Macro. So I'm really grateful for the question, grateful for the client, and grateful for you guys for tuning in every day. So we'll catch you back here on Monday. Everyone have a wonderful weekend. Cheers.